Hello and welcome back to the ROI podcast, the podcast that's obsessed with the art and science of return on investment. And today he's back. We're going to have another round with Chapman Scarborough from Proven Reserves. We're going to talk a very interesting play on Seagate, a short play. I don't normally go short, but today I am. We're going to talk cool company. We're going to talk coal, silver, offshore rigs, and whatever else, whatever the hell else comes up. Disclaimer, guys, anything we say today is just our opinions, two guys talking about things, giving our thoughts, nothing more. You are responsible for your own decision making. And with that, let's dive straight in. Chapman, how's it going? What's news, sir?
Oh, I'm going pretty well. Slightly recovering from a bit of a head cold from the last couple of days. It's not COVID though. I took two of those tests, so it's not that. But I'm fine now. So, but anyway,
Very
other
good.
than that,
Any
everything's fine.
creative breakthroughs from your fever state?
No, unfortunately, I mean, everything's
Well,
there's been some adjustments to the portfolio, of course.
well, let's talk about that. What adjustments
Yeah.
have been made since we last spoke?
So I definitely cut some of my exposure to Peabody, BTU,
Ooh,
mostly because the stock has gone up here, and I still think that there is a big overhang for the BHP asset purchases. And I think the stock has sort of rallied here because that news has kind of fallen out of the news cycle. Um, and I think once it pops back in, because look, the consistent theme that I always get whenever I talk to any other shareholders in any kind of a coal company is we don't trust management. So the initial reaction from the market is almost immediately going to be that, assuming they bought something, which considering they have like $1 billion and Whitehaven has even more, and it's just burning a hole in their damn pocket, they're going to buy something.
yep.
Whether it's accretive or not, who knows? But I think there's some downside risk here that you could potentially get a better reentry on if you're holding. But
Okay, so
we'll
that's
see.
interesting, and it's very topical because for those of you who may not be aware, there's the sale of two main assets here in Australia, coal mines. It's almost down here. It's like you can't give away a coal mine. It's unbelievable. We had Whitehaven stepping in, and we're looking at getting this mine accretive at something like 3 times the expected cash flows, and they were going to effectively vendor finance most of it anyway, and it was almost like the market was penalizing them for being in the race to acquire this asset because as you said, people they don't trust management in inverted commas.
No.
But if Whitehaven were buying back their shares, I think at like $9 or $10, and that now they're not going to buy back at 6 and buy this new mine. What's going on? What's going on? US versus Australia. We spoke about it briefly last time. Where's the best place to be if you're a coal miner? And why don't people want these damn assets down under?
Well, like there's the Queensland risk. I mean, there's that,
But in
which I
New South
usually think,
Wales, so since we last spoke,
you know,
the royalties have been announced.
did
They're not
yeah.
as
And they were
bad.
not as bad. Yeah, exactly. They weren't as
People thought.
bad. But Queensland is usually run by Labor, right? If I had to
Yeah,
guess.
that's
Yeah.
correct. No, you're correct.
Um, so probably New South Wales is much the same. But I don't know, it adds complication. So if you're looking at like what is it, AMR?
Yep.
And another coal company, but if you look at the AMR, they're primarily based just in West Virginia and Kentucky, right? So it's just one geographical area. And with BTU, you've got basically Powder River Basin to be your base, but then you also have all these nice Australian assets, accents and assets.
Assets.
And that makes the company a bit more harder to value.
Mm.
So you get some of that like pressure, and it makes the stock a little bit harder to long. I think everybody's sort of wondering like why has BTU been just vastly underperforming compared to all of its peers, and well, it's because it's got all these nice Australian assets, but it also has the Australian risk that goes along with it. I mean, yeah, you're Powder River Basin in Wyoming, Okay, the Wyoming government is never going to bother you. It's one of the best mining jurisdictions in the world. But you know, so there's been, I don't know, whether you're going to buy what is it, Blackwater, Duania or Duania, I don't know.
Yeah, those are the two. And I mean, is it to do with BTU's type of coal they sell as well? Has it got a real sort of mix? Whereas the Whitehavens are fairly focused in on thermal, and that seems to have
and these are met coal assets basically.
Yeah.
Because these are joint ventures. This was a BHP. Both of these mines are like BHP joint ventures with the Japanese, which is all about making Japanese steel. Because the Japanese still have a lot of blast furnaces. So this diversifies them into met in both situations here. Whitehaven would probably be buying the better mine, since apparently I believe Blackwater, excuse me, is harder, and Duania, that mine is semi-soft. So it's probably going to be accretive for both of them, right? But you have basically coal investors that just want their money now, and it's like, well, I mean, you've got a lot of cash here that could be going back to us.
Yeah, it's like the Canadian oil sands plays of the Megs, etc. in the world, where the management's promised that once they hit their debt targets, it's going to be 75 to 100% free cash flow back to shareholders.
Okay. We're not going to empire build, I promise. Yeah. So, it's
but I mean, look, let's look at it this way. I mean, you're buying these things 2, 3, 4, 5 times free cash flow. Do you think coal use is going to be dead within 4 years, 5 years, 6 years? Yes or no? And if the answer is no, are you not interested in Whitehaven at this level? Like, it just looks ridiculously cheap on a fundamental.
I mean, yeah, I mean, I'm interested in both of them. What I think is there's a timing of the acquisition here, and that I think that there is some downside risk because it's just the unknowns of like how much they're actually going to pay for these assets. And I think that's once that's out there, I think there's going to be there's going to be some sell off from the purchases, and then I think that's the time to buy. Myself personally, I mean, I've been on the BTU train for a while here, in the red, mind you. Finally went into the green. I'm sort of like, I want to get off the crazy train here just for a little bit, because it's not paying me to wait. That's the problem. I mean, yeah, it's paying you in a roundabout way. At least with Whitehaven, you're getting a 10% dividend. So,
plus
but with BTU, you're just getting the buybacks. So without a dividend, there isn't really an incentive there for you to wait, essentially. So I think that's part of it. If I was getting a 5, even a 5 or 10, let's just say a 10% yield on that, then no, I would not have sold. Or just cut back the exposure a bit. But for the time being, it's it's just where it is. It's like, I still believe in it. It's one of my more bullish positions, absolutely. But there's the market itself is a little. This is sort of a part of a little bit of a kind of a broader pullback in some areas, going a little bit higher cash than what I've been. I'm probably about 30% cash right now, which is as high as I've been in months. So, but
the whole recession expectation, or
it's a little bit of that. It's the market is starting to look a little toppish again. It's there's not a lot here, and as much as we get, not to get too far into the macro, I mean, I think there's still some there's, how do you put it, excuse me, too many unknowns, I guess. Is the Fed going to raise again? Where's is inflation going to keep sort of trending back up?
People are still going to keep buying tech stocks at 40, 50, 60 times PE.
Oh, you have ARM that just went public at 100 times earnings.
Yeah, it's interesting times. It's certainly interesting times. Now,
100 times earnings.
100 times earnings, yeah. That's a lot of growth to justify that.
Mm-hmm.
Moving into
For a glorified royalty company.
yeah, exactly. Moving into a fairly tight economic environment from everything that I can make out. In
Yeah.
terms of coal, one thing that follows coal, to kind of wrap it up, is natural gas. They tend to follow each other for logical reasons. You mentioned last time Cool Company as an exposure to LNG. I really find this an interesting idea. So this is a pure play on LNG carriers, correct?
Yep.
As far as I can make out, it's also the only pure play on LNG carriers.
There's two
To
that come to mind. So there's one that's
talk me through
FLNG or
this
flex LNG.
Okay.
So FLNG, they're both, I think, Norwegian based. FLNG, and they both have sold off a little bit lately. Not too much, but I mean, I'm still in the green on my position there. I was actually thinking about buying more today, of CLCO anyway. So these are the two companies that are let me go for my mic. They're the two pure plays. So it's just carriers for them. Versus you could have other shipping companies, or sometimes these are the ships themselves are just privately owned, not even publicly traded, and they lease them out. So basically, the structure of these businesses are you have the shipping company. They finance the ship, they buy the ship, and then they lease it out at a day rate to someone that effectively sort of controls where the ship goes. And whether they are then subleasing them, which can happen, particularly when you get sort of a blowout on TTF, you might have someone that will just sublease out that ship again, because they're then making even more money on their day rate. So it's like, okay, so whatever. So it's kind of an unsexy business. Oftentimes, who backs these ventures are the big investment banks, because they just get a percentage essentially, either through heavy debt financing. So they're coming in, they're getting their 6, 7, 8%, whatever it is. And it's slow and it's steady and it's always there. So normally for your average retail investor who's looking for something of an outsized gain, it's not really here. Cool Company is a slightly different story. The origins of Cool Company are they were spun off from Golar. So Golar used to be more of a, let's just say, a vertically integrated LNG play. What they did, or more so vertically integrated on the shipping and offloading side, at least. So they split out the ships, the carriers themselves, into Cool Company, CLCO. And then you have the floating storage and regasification units. And that's what Golar is. So those are the units that are sitting in Portugal or offshore in Germany or wherever else. And the LNG ship pulls up next to them, offloads the LNG cargo, and then turns back around to come back to Texas, and refills on another cargo, and then makes the trip again. Round trip to Europe is about 20 to 30 days, I think. So your arbitrage there probably at, let's just say, let me take a look at what the current prices are. No, come on, where are you? So I mean, your arbitrage there is probably 40, 50 million at least right now, probably a little bit more.
Per trip?
And it's like, yeah, per trip. So and basically your arbitrage between Henry Hub and TTF.
Exactly.
Now, of course, you have, yeah, oh yeah, of course, but you've got, these ships are expensive, and they have to pay them off over time and all that. But the real key to the story here is that the day rates can go a lot higher, because the cost into the day rate for that is only about $5 million. So that day rate can go up quite a bit, especially when the prices really start to blow out.
And so the
And
factors to cause said blowout on the demand side would be, from looking at management's
cold
presentation,
Europe.
yeah,
Yeah.
cold Europe, and this idea of replacing a certain amount of coal usage with LNG on the way to
Hmm.
this
Yeah.
energy transition. And that could be as much as 200 MTPA, according to the presentation. So the current market of LNG is at 400 MTPA. So that's effectively adding another 50% on the demand side
Hmm.
at the same time where shipbuilding orders are a little tight, let's say.
Hmm. Yeah. Well, you are having a lot of ships that are coming on stream here. They hit the market in about 2025, 2026, but that's also when you have a lot of new liquefaction coming online as well. So Cheniere is upgrading, or is adding more trains. You of course have New Fortress Energy. They're adding more trains. They're the only people that are going to have them this year. Fingers crossed. Uh, and then there's a couple of there's a Canadian company here or there, and there's some people beyond Cheniere as well. Um, but basically, the ships come online. They have a contract right out of the shipyard, and they go and they service new routes. They don't really compete with like existing ships, so there isn't necessarily going to be like this collapse in the day rate. Like if anything, it's just serving new locations, areas that are going to be underserved markets, let's say, that are going to be bringing power plants online or replacing capacity in Europe or wherever else. It's sort of a natural progression because you've got the Permian that's becoming more gassy. So you have all this natural gas in the United States. You have no idea what the hell to do with it all. Um, so unless we want like natural gas prices to basically be free, I mean, they're already really quite cheap in the United States. It has to go someplace. So this is sort of it's a part of, this is what has really decarbonized the United States in the last 20 years, probably more so than any other OECD country in
Yep.
terms of carbon output has been the United States, mostly because we've gone from
Because of the
coal
gas.
to natural gas.
Exactly.
And that's just going to continue, worldwide. So we're just going to be exporting that. And it's great. It's good.
It's good for you guys. The Canadians can't get their act together, so essentially you got the market to yourselves.
Well, I mean, yeah, the thing is that like, so the Canadians have their primary assets in Alberta, which is in sort of the middle of the damn country, right? So you've got to get a pipeline to either one side,
That's a lot of
and it's like,
infrastructure.
so whereas we're in Texas, where we have a lot of that, and you've got huge assets right there, right next to the ocean. It's fantastic, and Cuba doesn't have a powerful navy, so it's great. And so we're able to basically get ships through there without a problem. The more recent development, of course, has been the Panama Canal shutting down, and that's sort of adding some pressure on the day rates. Ultimately, there's like, does Japan return to the market in a bigger way, and also is Korea as well, and they start competing for these ships again? I'm personally thinking that we're going to have a much colder winter because we've got the return of El Nino.
Yep.
So and everyone in Europe is not really going to be prepared for that. I mean, everybody, right now the forecasts are just predicting the status quo because that's of course what they're going to predict. You're not going to have all of
And
these.
last year was like a
Yeah,
freakishly warm year. They got super lucky.
exactly.
Yeah.
Oh yeah,
But what
and they cannot
the odds of that
store
happening again slim.
what, and they can't store enough gas for the full winter. So
It's got to come.
it's like exactly. So once it starts depleting, that just is going to add pressure to day rates. This is very important for CLCO because both of these carriers, Flex, which currently is trading for about 29, just under $30, and it pays roughly a 10% dividend. CLCO is about the same if you were to consider what. So we got 1358. Excuse me one moment. And Yeah, so 12% yield on CLCO. And that's probably going up. So the reason that so these are basically dividend stocks in the neighborhood of essentially a good 10 to 12% yield.
With a
They're fantastic.
decent valuation on their net asset value. So Cool
Mhm.
Company's fleet of what is it like? It's now going to be 13 with these two new
Yes.
carriers coming online.
Mhm.
Uh, it costs how much would an LNG carrier cost to rebuild? I just did a bit of a deep dive on VLCCs, and with
Oh, I think a new one would be about 300 million now.
wow, okay, so that's more than that's double what a
It'd be
VLCC would
closer
be.
up there. Yeah,
Goodness
it's
gracious.
getting up there. Um, so I mean, well, a new one would be 200. I don't know what the it's up there. I
So
know
somewhere
that there
in
are
that
there
ballpark.
it's several hundred million. Let's just put it that way. Um, I know that those are getting more expensive. Um, so they're getting Tiger and Panther, which is the names of the ships, and they had a purchase contract for them. Um, the option to buy them at a much lower price than I think about a 20%. I think it's probably about 20% discount versus let me look up what the actual price of those were because I don't have that in a projection, believe it or not, because it
So
wasn't
when
never.
you look at a valuation, do you start off with a fleet valuation and say, okay, well, this is what the book value is, but that's of course been amortized down using accounting principles. What would it
Sure.
cost to rebuild this from new today? Would probably be significantly higher, I'd imagine. And then kind
Yeah,
of
I
like,
mean, in terms of the valuation that I actually go with like a say a CLCO cool company is you'd basically take um what the let's see, oh, there they are. You would take what the market's currently valuing them for on a times earnings basis. That's just what I do.
mhm.
And you project what additional earnings are going to have in the future because you're going to have the revenue growth. And then I just go off that and I say, okay, well, this is conservatively where these are going.
Yeah.
Because you just have to assume that the market's going to continue to value them in the way that they are now. It's just going to be bigger, so the stock price is going to go up. Um, so
Now, with a
that's
question on that, so if we take that, I'm going to share my screen here with a highly technical back of the envelope. I've used analyst numbers.
oh
Analysts,
god,
uh, analysts looking into next year are projecting negative free cash for this company. So I've kind of separated that. Yeah, I separated that out. So we're looking at, according to them at least, 231 earnings per share.
mm-hmm.
And I've applied an 8 times multiple on the PE. Talk me through what are your thoughts there? How would you approach it? Is that reasonable? Is it unreasonable?
Sure, yeah, 8 times earnings is fine. I mean that's now is this for this year? So
Uh,
basically year end December.
Year end
Mm,
2023.
yeah, so that would be. I think they've got a year in 2023. Let's see here.
Let's take a look and see if anything's changed. But if you look at the estimates, that's what I've worked on. So I've looked at EBITDA divided by the shares outstanding, just to keep it super simple, earnings, free cash, and then done an equally weighted average to come up with an estimate.
Yeah.
EPS. So 231 is estimated for the
Mm-hmm.
end of this year, and then
Yep.
apparently $2.70 for next year. That is a bit.
That's a bit low.
I would
Okay.
agree.
It's like
However,
way low. I don't
yeah.
know what the hell I don't know how the hell they're coming up with that one.
So what are you looking at? Let's talk earnings, and then we'll talk this idea about the free cash.
Yeah. Um, what have I come up with for free cash? So the earnings is probably correct. Right now, what I am, uh, I'm actually projecting about $4 for this year.
Ooh.
Um, a VPS, 5 for next year, and then $8.20 for 2025.
Okay. So bullish on the earnings,
Oh,
and
very actually. because I know what contracts are coming offline.
Nice. And the
So
multiples you're using?
I just use a 5 times multiple,
Okay.
5.7, which is what it's trading for now. Roughly speaking, if you were to basically extrapolate the 2 quarters that they've had so far, and use those to determine what your EPS is. So, because right now, if you were to so I mean, look, we've earned $2.09 in just the first part of this year already.
Yeah. So,
So
231 year end is like, we need to
is
adjust that higher.
So that's why I have got the $4 year end.
Makes sense.
And if you were to extrapolate that out to basically well, going off the first one, I think, which is 125. So let's see here, 15. Yeah, I think I was assuming an 8 point, or let's see, 5.7, yeah. Okay, so current, 3 times. So even going off like, if you were to assume a 5.75 multiple, that's what I was essentially just kind of being conservative here, because it's trading right now for 3.
So you assume no multiple change, but that the earnings actually come in and people realize that their earnings estimates have been way too low previously.
Well, no shit.
Yeah.
Yes. So I mean, I'm predicting right now, I've got a current year-end price on this. Oh God, what did I put in here? Actually $23 by year-end. Oh, that's interesting. Oh, we'll see if that actually happens. That might be a little bit bullish, a little bit much. Then 28 by next year, and then 47 by 2025.
Okay, so we're in, you and I in 3-year estimates. Yeah, we're in the same ballpark.
3-year estimates were pretty similar.
Yeah,
so,
but I mean, even at the end of the day, I mean, if you're not getting that multiple re-rate, there's still nearly 100% upside based just on the actual earnings coming in versus whatever the hell the analysts have been suggesting. So it'd be interesting.
I mean, you're right now, the most important thing for the company is that they are establishing a steady dividend. So you're getting, we've had 2 41-cent dividends here.
Yep.
Per share,
and they're
per
paying
quarter.
out 100% of net income as a dividend, according to management's plan. That's roughly
speaking, yes.
41, I mean, 41 for the quarter. Yep.
Yeah, net income was a little bit higher. It was actually my projection for last quarter was actually 30 million in net income. They ended up having 44 because they had some derivatives that they made some money on.
All right, so Q2, I'm looking at the pres now, 94% was paid out as a dividend.
Yeah.
Which is very handy. The one thing I don't get with this company are the amortization schedules for some of the debt that they've got coming up.
It's also important to remember that in Q2, that dividend is also based off of last quarter's earnings as well. So it's going to be paid in the subsequent quarter, sequential quarter, sorry. But yeah, so it's more than affordable. I'll put it that way.
Yeah.
So, but go on.
No, so balance sheet looks fine in terms of their serviceability. I just have questions around this debt maturity. So 2024, 2025, how they're going to pay for the new builds, and they're looking at capital outlay for the 2 new builds. Are they debt financing this? And what's going on with this 2027 maturity? So if you're looking at the fixed debt and their total debt, and when these are maturing, that's fairly recent. What's the best way, instead of paying down the dividend, would you change the dividend to pay down the debt structure, or how would you approach this?
So some of this is going to, of course, be refinanced. And by 2027, there could be potentially lower interest rates, of course. the other thing is that by 2027, I mean, by 2025, their net income annually is going to be just under $500 million. So by 2026 and 2027, there's a fairly good possibility that they're going to have enough capital here to cover these debt obligations, and put it that way. It is somewhat concerning, but the earnings growth for this enterprise is kind of on a rocket. And a lot of people don't necessarily realize that. And this is why you actually like CLCO over FLNG. Because FLNG they have a lot of ships. They're actually slightly bigger ships. And they are, let's put it that way, they're like, let me think here. I think they're 170,000 metric tons, 175,000 metric tons. And they're more uniform, and they're also newer. But here's the thing: they're also locked down to long-term contracts, like almost all of them.
Hell of a lot in contracted or revenue backlogs.
Exactly. So actually you just passed it right there. Yeah, that one right there.
There we go.
So the contracting, yeah. So this is where you're actually getting your torque here with CLCO, because they already have one ship, which I've declared is the Blizzard. I don't know if it's actually Blizzard or not. That was signed early to $158,000, right? And that contract goes into effect in second quarter of next year. In between that time, they have a ship coming off contract this quarter. And then they have another ship that's coming off contract in the quarter after that. So you have two ships here that are coming off contract, and they're going to basically be re-signed at a far, far higher day rate. Currently, you're looking at, particularly with the new builds, is where this gets really fun, because we've had news that there was a new build that was signed for well over $200,000 a day.
When was that?
Oh, just a couple weeks ago. I mean,
okay, so these ones rolling off their contract are presumably going to be in that ballpark when they re-sign. Oof.
Exactly, because they're coming off, and the important thing is to come off contract in winter when the day rates are the highest.
Absolutely.
And you're going to have your customers, whoever who's ever signing the contract to basically have control of the ship so that they can get their LNG and their gas. They're going to be the most excuse me, amenable to a higher day rate in winter. And so you have not only that, but then you have another ship that's rolling off next year. And then I think, let's see, when was Crystal re-signed? So you had three ships that contracted New Year. So one of them was signed early. You've got one ship next year, and then you have not only that, but you also have Tiger and Panther coming onto the scene next year. They're probably going to be signed for a contract well north of $200,000.
Yeah. How long are these contracts normally for LNG carriers?
A couple of years. So okay. That is the way that they go, essentially. And it's sort of why these businesses are somewhat boring, right? Because it's kind of a known quantity. If it's
very predictable, you've got this backlog that's sustainable for a few years, unlike the tanker rates or some of the offshore services that are
which is far more variable. So if you're normally scared of shipping companies, rightfully so, because of that crazy variability, this is something that you could take a lot more comfort in, because the revenue is going to be the revenue. They're going to get the day rate no matter what. It doesn't matter what TTF does. Once that day rate's signed, it's like great. You have contracted this ship for this day, for this amount per day for the next, 3 years.
Yeah, you can model
Please,
that
thank
out
you.
much more.
Give me my money. So there's that. And you use that, and that's where your a little bit more excitement here in CLCO is because you're going to get the revenue growth that you're not normally going to get in a play like this.
Because of the new builds coming online, plus those
Yeah,
two rolling off their previous charters.
It's not only that, but it's also you've got a charter rolling off next year as well, and then 2 more in the year after that. I mean, so you have, and you could see where you got open here, and that's where you're seeing quite a few here, but you have a lot that is coming off here, right when, like, that Q4, see that
Yep.
Q3 to Q4. So that's one ship that's coming off, and then you've also got another one as well. So it's definitely at least one, without a doubt. But I went through this, and some of this looks like it's changed a bit, and I think it's reflecting the ship that was re-signed. But
you've got a little bit of an upside kicker.
Yes,
cool company.
much. So that's where you are going to get into a much higher one. You're going to get, even before these are signed, anything that has anything LNG in the name, once you get it like a blowout in TTF, it's going to get a bid. For one.
Yep.
The second part of that is that they're also going to have earnings that are going to go up, potentially higher dividend. So it's sort of a it's an interesting place to be, essentially. And
so
you have a lot
mid to longer term investable, given the nature
this
of
is
the business.
It's like a 3-year hold.
Yeah.
I mean, it's a 12% yield, and it's paying you to hold it.
Yeah.
So you have a lot of revenue upside here, and you're getting paid a nice quarterly dividend to hold this thing. So why not?
Absolutely. So we're rotating out of some of the coal names, at least, with the FUD, the fear, uncertainty, and the doubt, and rolling it into
a
something
little
like
bit,
this,
yeah.
a little bit more
I mean,
predictable.
look, the problem is with coal. The other thing with coal, the problem with it is that it's just so uninvestable.
Yeah.
I hate to say it.
It's not exactly popular. Yeah.
You're never going to get a major fund that is going to go long BTU or Whitehaven or whoever else. So your return in those names is basically a combination of buybacks leading into extraordinary dividends in the future. And that's why I think a lot of the existing shareholders are just so jumpy about potentially having to spend a whole bunch of cash for
new acquisitions.
Yeah, exactly.
But it's interesting. That's kind of what led to the whole thing in the first place, because no one can get financing on this thing. So there's like the Japanese, the Singapore trading house, and then like Whitehaven have got the cash in their pockets, and they'd have to use all of that. So it's all going to be interesting where that plays out. But in the meantime, I mean, why do you have to go out into that area of uncertainty when you can look at a play that's so correlated, such as LNG, and you've got probably a discount to the asset value plus this revenue growth, highly predictable given the nature of the contracts. So I think it's a very interesting way to do it. Moving on to something that's a little bit controversial, but everyone loves a little bit of a speculation, particularly to the downside. We're expecting harder times, if not Q4 this year, Q1 next year. There's a company out there whose business model is pretty close to obsolete, as from what I can tell. I have no idea when it comes to technology. Let's talk through the thesis surrounding Seagate. Their stock has gone up. They hit hard time. Their sales are slowing. They raise money, and instead of investing that into improving their business, from what I can tell, they have bought back shares and paid themselves dividends. and they've got themselves into a spot of bother.
Yeah.
Take it from the top.
Oh, that's a way to put it. A spot of bother.
Yeah.
So the issue with Seagate is of course this is basically this dividend. They have, oh, you're likely bankruptcy. Okay, all right, we'll go with that. So basically, the they just announced a essentially a convert deal for about $1.3 billion that has an initial conversion price of like 80 something dollars a share or something. I think it's like 82 or I don't know.
Good luck. And it's paying like a 3% interest when T-bills are paying, call it 5.
Well, I mean, apparently,
who's going to buy
as it's been trained to me, there's a lot of institutional investors out there, or institutional grade investors out there, that have been basically trained like dogs to, immediately just buy this stuff up, because the banks apparently have already saw this. I have no idea. The banks already have this stuff sold, apparently. This will probably save the dividend for a quarter. There's some other things that, they're going to have to do beyond that. Once that dividend is gone, then this stock is going to sell off, because it's held like 88-90% by institutions, and they hold it just because of that dividend.
Yep.
And their basis in it is probably $30. You have the CEO of the company who just had his largest exercise in options ever. And he did something that he's never done before, which is that he dipped into next year's expirations. Never done that before. Normally, he exercises options around this time of year for the ones that are exercising, or the ones that are expiring this time of year. Did something a little different this year. He did that. In addition, he also dipped in to half of the options that are expiring next year.
Would it be
immediately after
they won't be worth as much next year?
Well, the strike price was $30, and so he's got a little bit of the $30 strikes left. But yeah, so immediately after that, very soon after that, we had I believe it was a 4100. Let me take a look here. Yeah, it was it was a 14.4 sale of securities notification, insider sale of securities notification, because their second largest shareholder just liquidated almost half their holdings.
That's generally not a good sign.
No, it's not. So they have a product, and even then, they have started to pull the various levers that they can pull. One of which is, of course, the sale leasebacks transactions.
Yeah, so talk to me about that. So where can my thesis go wrong if they how can they, what have they got left to raise liquidity? Someone said selling office buildings. People have told me all sorts of, people have told me all sorts of crazy stuff. What's left for them to keep this sort of 800 million cash in the bank balance? And the reason that's important is because they need at least that much to be allowed to pay themselves the dividend. Where can I go wrong? Like, I guess this convertible note is one way they're raising cash.
Yeah. So ultimately, they have to have some kind of a recovery in the hard drive market that just doesn't seem to be happening. I know a lot of people have argued with me on this. I've had some pushback on it. It's like, oh, it's the hard drive. Tape even still exists, but tape exists for a very specific purpose, because tape is a good offline solution, So basically you have three kinds of storage banks in the enterprise. You have what's available sort of immediately on site. Then you have Nearline, which has basically become sort of a bastion of Seagate. They don't really sell these things to consumers anymore. If you had Micro Centers, I don't know what you call a computer store, or typical good computer store in Australia, but yeah,
I
they still
couldn't tell
sell
you. I
them.
don't know.
So they still sell the hard drives at Micro Center here in the United States. But everything is hard. Even your basic $500 cheap ass Dell tower comes with a solid state drive now.
Okay. And then you got the cloud.
More importantly, well, that the cloud is Nearline,
Okay.
actually. So Nearline is what you don't immediately need, basically, but it's what you can sort of
Okay.
retrieve kind of on a planned basis or whatever else. Then you have offline. Now, offline storage is the bastion of tape, basically, old-fashioned tape.
Mm-hmm.
Because it's cheap, it doesn't really degrade that much, and it's cheap. The hard drives don't really exist in that space because they're too expensive. And they don't have the kind of like, and the various technologies that to try to extend the life of the hard drive is not really coming to fruition here. So even Western Digital has had to actually resort now to selling off, doing a sale leaseback on their offices, which is crazy because they actually have a future, mind you, because they bought SanDisk a couple years ago,
Yeah.
and they make solid state drives. Okay, Seagate does not make solid state drives. They rebrand them, and they pay a lot of money to have like the highfalutin parts, so they can basically say like, oh yeah, we have the fastest solid state drive, because for them it's just a marketing exercise. It's not actually something that they're looking to make money on. So they can extend this out for quite some time.
How long?
But
That's the question.
a couple years. I mean,
If
before you might have a bankruptcy. But is the stock going to be in single digits here? It's a possibility.
okay, how do we
Um,
get to single digits? If you put
well, the
if you
first thing
put
that happens is,
$25
well,
puts.
the first thing that happens is that the dividend is cut. So you're going to get a
Mhm.
50% sell off in about a month from that,
50%.
probably. Oh yeah.
Ooh, yeah.
Well, because you got a lot of funds that you have about probably 30-40 million shares that are just
Okay.
locked up in
Let's have a
income
look.
funds.
So Vanguard, Sanders Capital, JP Morgan,
So
Fidelity. Oh yeah, yeah, yeah.
you've got a lot of funds in there that are just income funds. They hold it purely for the dividend. They will have to sell it immediately after. They don't have a dividend in fairly short order anyway. The next thing that happens after that is they get kicked out of the S&P 500.
100. So we get a multiple downgrade.
Yes. So they get kicked out of the S&P 500. That's probably good for another 20-30%. Um,
Mm.
and then
With it,
at
just
this point,
just a side
yeah.
note, with an NTMPE of 164 in a
Oh, they don't
company
make any
that's
damn
not,
money.
what the
I mean,
hell?
and
Yeah.
they're and these fools are basically sort of on a conference call projecting infinite cash flow. Never mind the fact that they have accounts payable of 1.7-ish billion dollars now. So that's sort of
Yep,
short-term debt.
1.6.
1.6, yeah.
That's a problem
Uh,
when your cash is 786 as of
yeah.
June. Yeah.
I mean, so they basically sort of extended out the accounts payable. Then they have another time bomb here in January, so they're going to have to do another one here, because they have $500 million of debt that's coming due in 2025, January 2025, within a year, basically. So anything that's within a year counts against them, essentially, in terms of their leverage and liquidity stuff. So they're going to have to refinance that.
Because it
So,
becomes a current liability for those who aren't
so
accountants. Yeah.
well, it's not just a current liability, but it also for their lawyerly, it counts against their $700 million, basically, because they have
Mm.
to have that $700 million in all times, because in theory, they should be able to always pay off the debt, in theory. But
Yeah, with 700 million cash when your debt
yeah,
is, yeah, okay.
so, and basically the way to play this is, you've got the safest way to play this is the $25 puts for January 2025. There is a possibility of a bankruptcy. You never know when the bankruptcy is going to happen. all it really takes is basically the creditors saying that they've got enough, or they can't find. I mean, they're making a huge ask here, basically, with the 1.3. It's amazing that the stock is still $60, because basically what they just did was a $1.3 billion equity offering to the market. Because remember, these are converts.
Yeah, with so a market cap of 13, let's call it,
Which is amazing.
Yeah, like 10%
What the reason why
dilution.
this is happening is, of course, is because it's still owned by institutions. And the
Yeah,
institutions
the
own it for
only
the
way.
dividend.
Yeah.
And so it's not going to sell off until that dividend is gone. This is why they are bending over backwards, and they are doing every little bit of financial engineering that they can possibly do to save the dividend.
With
And
a 4.4%
they just guided
dividend.
down. Keep in mind, they just guided down the next quarter.
Yes, they did.
So, and they have had to do this over and over and over again. Why? All right, so maybe you can pull up a website. Let me try to find it.
Well, you can share your screen if you wish. I'll stop sharing. If you know
Yeah.
what you're looking for. I just don't understand the mindset of the institutions. You've got T-bills really at
Well,
5%,
I
and
mean,
you
look,
and you're
it's
hanging onto this thing.
diversification. Well, it's diversification, I guess. I don't know. I mean, and a lot of times, look, their basis in this is $30. So if they sell it, they're going to incur a
Okay,
tax
sure.
loss, or they're going to incur taxable gains. So there's that part. But yeah, it's let me try to find this. So you've got Pure Storage out there that is basically saying that in Nearline, the hard drive is dead, which makes sense because there was a Wells Fargo analyst a couple years ago. He still covers the sector, but he basically came up and he came up with a sort of a prophecy, I guess you could almost call it, that once SSDs reach a price that's 5 times greater than hard drives, HDDs, enterprise is going to favor SSD over hard drives. Why? Well, because solid state drives require like 80 to 90% less power to run. So your total cost of ownership over, like, say, 5 years is actually less with a solid state drive than a hard drive, and you get faster storage. So, they're going to start favoring the hard drives, and you're seeing it they're going to start favoring the solid state drives, and you're seeing that in, like, the Facebook supercomputer they announced last year, all solid state drives.
Yeah.
Like petabytes upon petabytes of solid state. Why? Because if you are in this generative AI madness, whether you like it or not, that kind of computing needs immediate access storage, because you're rewriting these generative language models all the time. So you have to have insane rewrite and write and read speeds. So it has to be all solid state. You can't do hard drives with that. So all of this new server build out, they get nothing. And you're seeing that in the fact that they are constantly having to basically lower expectations. Now, they blamed it, of course, on China, which is bullshit. But
Yeah. If in doubt, blame the Chinese. But yeah, no.
Yeah.
Does that all
So,
fail safe?
Yeah.
Okay, so with those two factors, we potentially get a 50% cut in the stock price. And that could take what, a month if they get this announcement. So we're sweating on this dividend announcement.
So yeah, it's probably, I mean, I don't know if the dividend is going to be cut. I think it's probably saved for October. Just based on some internal calculations that I keep a little bit closer to my chest. Of things that I know that nobody else knows, because nobody else reads things. Hint, hint, people. But
Yeah, like the analysts of New Fortress Energy and Cool Company obviously don't read the
well, I
presentations.
mean,
But
look,
anyway,
analysts, they're busy people, and and they have to drink their soy milk lattes, and and have thousands of earnings calls every day, and they just simply don't have time. In between their chauffeur driven Mercedes and all that other stuff. It's just, can't be bothered with it. So, but yeah, basically it's these hard drives are, they're just, God bless it. I'm trying to find it. But it was like, drive, no, what would be, exabytes. There we go. Because you're seeing essentially this dramatic drop in drive shipments. Here it is. So here, let me show it to you. Let's see, try to share the. So yeah. Let's see here. So let me do this.
So the idea that they also produce SSDs, which is dependent on data centers that use hard drives or HDDs, from what I understand, which is not much when it comes to technology. But you're saying they make no margin basically on these SSDs.
Correct. Yeah.
Okay.
Well, they don't. Yeah, they don't make any margin on the SSDs. That is a fair assessment, because they're just rebranded. Basically, they don't actually make them. And it's, in addition to the fact that it's just sort of something of a low margin product anyway. So, let's see here. Okay. Cool. So can you see this?
It's small, but yes, I can see it.
It's small. Is that better?
That's better.
Okay. Oh, wait. Great. Cool. So, I don't know if I can make this any bigger, but basically you'll see this is the exabytes shipped essentially in total.
Okay.
And then of total capacity. And then this here has never happened.
That's my question. Why is it going down?
And it's going down because Nearline storage, which was basically the last bastion of the hard drive, is going solid state. That's it. Yeah. So there's no recovery here, basically. You're going to have a couple, one or two kind of use cases here, or people that are not going to necessarily switch over. Basically, their future is just maintenance of existing systems here.
And how much money are they really going to make out of that?
Not a lot, because and the thing is that and so there's been this talk about Hammer, of course, right? Whereby Hammer is apparently going to save them. This is actually going to be a problem for them, because it's going to lead to less shipments. So you're going to have less drives shipped, basically. We're going to up the storage of our drives so that anybody who actually still wants to use them, they're going to need less of them. Oh, great. Our capacity units are going to fall, which means we're not going to be utilizing our facilities as much anymore. So it's a double-edged sword. This is why they're slow rolling it out, or it's either that or a combination of that, I'm sure, and the fact that they just don't spend anything on research and development. So
yeah, well, why would you, when you can just buy back your stock and pay yourself dividends, apparently. So let's talk about this ratio of debt. So according to their debt, you're saying they're supposed to keep at less than 7 times, and so debt to EBITDA or adjusted EBITDA or some bullshit calculation. What is the actual calculation? Because if they breach that, do they get downgraded and then
well, no, it's not that they get downgraded. I mean, if they breach that, then technically it's a default event for their creditors. Now they could be downgraded on their debt from Fitch or S&P or whoever else, Standard & Poor's or Moody's, and that's sort of a separate thing, and that can cause them problems. But basically, they have an adjusted EBITDA number that is calculated as as their credit agreement essentially states how it's calculated. This is what I call lawyer accounting. There's generally accepted accounting principles, then there's lawyer accepted accounting principles, and then, you know, basically there's accounting principles that is subject solely to them based on just what their credit agreement is. So they got that expanded. And the big change for that everybody really needs to realize is it went to a net leverage ratio. Why is this important? A net leverage ratio means that if their cash goes down, their leverage ratio goes up. That was not the case before. So, yeah, that's sort of the whammy here. Because basically what's really happening is you have the creditors that are circling the assets, and they're slowly but surely restricting, like, for instance, if Seagate were to sell an asset, for instance, let's say, it can't necessarily be used to pay the dividend. It actually has to go to paying off the term loans first, which is why you having this recent subscription. It's going and getting rid of those term loans because it's been a headache for them, for Seagate. It's also been a headache for the creditors too, I'm sure.
Well, this is the thing. Are the creditors really going to want to? I mean, if they call in this loan, if there's technically a default event, they breach it, they say, okay, that's it. We're not comfortable anymore. We want to be paid back.
Well, I think what will really happen is that they're just not going to have more new creditors, essentially, because they're not really necessarily getting more cash here. What's really happening is they're paying off loans for just more. They're just kicking the can sort of from what is mostly going to be 2025, 2026 down to 2027. Like,
they've already amended these debts how many times? Like
9, 8 in total, really. But yeah, they're on the 9th one. If it's a sort of a quasi amendment, but yeah, it's really just 8, to be honest. It's just a slowly dying company, basically. The thing is that the challenge here is timing it, because you have to time I think the likelihood of the dividend cut is probably more likely after for the December quarter.
Okay, so they've moved that down, that catalyst
yeah.
down the road, maybe a quarter.
Yeah, pretty much.
We still got.
I mean, you know, yeah. So, I mean, it's I don't know. It is what it is, but it's something that there's the real potential there of fireworks, because they may not meet the thresholds that I think they're going to be able to somehow meet in October. So I wouldn't, if I was advising people on a position, giving them not financial advice, I wouldn't go full in on October. So like I would keep anything in October to be speculative.
Yeah.
And we'll see what happens in December.
Whether they move the can down the road a quarter or two, if you're looking at January 25 or 26, I mean, eventually the music's got to stop and they're going to be without a chair, right?
I mean, the music is you could probably, in my opinion, the music has stopped. We're just sort of in slow motion, and they're sort of running for a chair right now, but the chair is already gone.
Chair's gone. I mean, no one's. I mean, you and I
spoke about it's hard to find.
No one's going to acquire this company with the convertibles and the debt load they've already.
The problem, there's a poison pill here.
Uh-oh.
In the event of the change of ownership, the debt has to be paid off right away.
That's a lot of cash outlay.
So what's the enterprise value of this company?
It is.
That's the purchase price.
18.3 billion.
No one is buying this company for $18 billion. Forget about it. I mean, that would be buying this at, let's just assume, oh God. Oh, that would be buying this company at like 45 times earnings, assuming they start making like $1 million a quarter, which is a big, which considering they're losing 100 million every quarter right now, is a big if. So that's the problem here, is that the debt has to be paid off immediately in the event of the change of control. So
Yeah.
no one's going to buy this.
Yeah. With the analysts, I'm looking at
Uh,
analyst projections again. Net income normalized at 40 million for the end of this year. Sorry, that was announced for 23, and then 46 million end of June 24 estimated. That's a long way off.
oh yeah, and how much is that? I mean, they can't afford this dividend. I mean, look, this is what you just have to know. Okay, if you're paying out $170 million a quarter in a dividend, and you're losing $100 million every quarter, the clock is ticking.
Yeah.
And you can do all sorts of shenanigans. You can, you know, but there's a limit to the financial engineering. You can only piss off so many of your suppliers, and you can only accelerate payment on your receivables so much before you're out of levers. And they are approachingly out of levers in a market that, as you saw, everyone please go back and just take a look at that chart. This has never happened, okay? And even if it did, you had like maybe 1/4 of 2 quarters of downside, and then it immediately recovered. You have never had basically quarter after quarter after quarter
distant decline
of just insane levels of decline. Why is this happening? Because Nearline is going solid state. Simple as. So,
and
they don't have a lifeline.
Play out.
They don't have a lifeline. That's it. So, there we go. There you go.
Interesting. Okay, so wrapping up, give me your thoughts on where you see the opportunities in terms of the space. You and I spoke. Uranium has taken off since we last spoke, so that is new.
Oh God.
So we were the contrarian indicators there. However,
I mean, I made a lot of money on it. Don't get me
exactly.
wrong.
I was just going to say we're positioned for it. We just were like sitting back. We weren't quite as enamored with the bull thesis as other people, but it looks real. I mean, SPUT traded at premium to NAV, and
so
coming into the weekend,
Cameco is getting a bit stretched here.
So how are you playing? The question.
I'll be honest with you. I have a very small short position. So full disclosure there, everyone.
Okay.
Why am I short? Because there are 3 very, very big reasons why Cameco is going to fire off a cap raise here, in my opinion, in probably the next 2 months. 1, Cigar Lake is declining precipitously. And they're going to need a mine that is ready to go, and it takes about 4 years. So they're going to need to find something. There is a couple deposits of possibility in the Western Basin, Eastern Basin of Athabasca that they could find. So that's one possibility. 2, they're going to need capital to finish the acquisition of Westinghouse. Never mind the Westinghouse issues themselves. I don't know if we touched on that last time.
No.
But so, the last time that this is all eerily, the Westinghouse acquisition, by the by, is just eerily reminiscent of the 2000s, when you had British Nuclear Fuel Limited, BNFL, or BNF. Yes, I got it right. Sorry, who bought this from CBS, I believe, because CBS bought Westinghouse, and basically then they got rid of all the industrial assets, and they sold Westinghouse Nuclear for like $1 million. Okay, $1 billion, excuse me. They really sold it for $200 million because there was this assumption of like $900 million in debt there. I think it was 1.1 billion. BNFL announces a couple years later they're looking for a buyer, right? So Toshiba comes in and says, BNFL thinks they're going to get 1.8. Toshiba comes in and says, we'll pay you $5 billion. Okay.
Straight out of the water. Yeah.
Toshiba never makes money on this damn thing. And they eventually have to go sort of quasi-bankrupt, because in Japan, you can't have a negative equity balance. So they have to have this fairly substantial equity offering for all the losses that Westinghouse incurred.
Oof.
Let's just say that Westinghouse starts building reactors again.
Mm.
Is there any guarantee whatsoever that this isn't going to happen again? I don't think there is, because I don't think that anybody has learned their lessons. Having said that, so is that going to come back to Cameco? Potentially.
Well, they're trying to, my understanding is they're trying to be the fully integrated, like yellow cake to what's start of the value chain, end of the value chain.
Look, you don't want to selling reactors is a fool's errand. You want to service the reactors, that's fine. But you're spending a lot of money just to buy Westinghouse's fuel business. Just my point of view. I don't like the Westinghouse transaction, in other words. I don't think it's accretive at all. The debt that Westinghouse has, which is several $billion, has not been paid off. The enterprise value of Westinghouse is like $8 billion. They're buying it for $4 and some change. So what does that tell you? Oh, they have a lot of debt. I went actually into Brookfield's their books for that. They'd never paid off that debt. It still exists. Now, Cameco is not going to have to consolidate that because they're going to be 49% ownership, so it's not going to necessarily show up on their books. But
that's a good point.
How accretive it is, I don't know. And getting into the reactor building business is just fraught with,
That's a huge unknown. That's a huge unknown.
So
if you're investing in uranium, is that even what you're looking for? I mean, the idea is that you're speculating on this big upside on the supply squeeze. So why are you going to go
with what? With mines that have no real plans on being in production anytime in the next 5 years?
Yeah.
I mean, there's a lot of out there that's like it's one thing if you're buying Boss is going to have production. It's one thing if you buy even Paladin, you're going to buy production. But if you're buying Bannerman or Deep Yellow,
but the pounds in the ground are so cheap,
or Uranium in the Earth Corporation, because that's where it's going to stay. Trademark.
Yeah.
UEC, Uranium in the Earth Corporation. Because that's where it stays.
Not a bad lifestyle company if you're on the board.
Don't whatever.
Anyway, I got into trouble for saying that, so let's.
Yeah, no, we're not saying that these are lifestyle companies at all. These are perfectly legitimate businesses.
with a high threshold to production, let's say.
With a very high threshold and a very long timeline. But like all things, wine ages like, over time. Fine wine ages, it takes a long time. Anyway. Excuse me. So the other area of third reason, by the way, why Cameco is going to have to do a cap raise is buying a controlling stake in GLE, which makes a lot more sense, actually, than the Westinghouse acquisition to me. I don't know what the hell they're doing wasting time with Westinghouse. They should be buying GLE because GLE is the linchpin in the problem in OECD supply, which is enrichment. And Silex can get you there. Why the hell they're spending time wasting time with Westinghouse, which brings on a whole host of
problems, where you could be going after what the real choke point is, which is that enrichment processing.
Well, exactly. But I'm not a fly in the boardroom. I mean, it is what it is. And at this valuation, I mean, it's getting a little stretched. I mean, look, I have a valuation on Cameco. It's I think a fair valuation is. I hope everyone's sitting down, but I think it's $10 a share. If you put you put all their production out there, I mean, folks, it's a mine. Okay, these are not tech companies. You can't give this a tech company valuation. It is a declining asset. The only money that you're ever going to get out of this, folks, is the money that is from that mine asset. That what you can get out of it. That's it. Then it's gone. So if you think that you're going to get, a $40 payback on Cameco, that's requiring. I mean, yeah, that's requiring a fairly aggressive assumption. Because look at it this way. I mean, what they're They are making a gap profit.
They're making a gap
Good for them.
Gap earnings next year estimated at $1.08. So currently, if you believe all that, that's 40 times.
And Cigar Lake is coming offline in 5 years, which is their second biggest asset.
So
in
five
terms
is a
of
lot
production.
less. Five is a lot less than 40 times earnings. Just saying.
So, it's yeah. So and yeah, and even then, there's also potentially some issues in MacArthur River. They are mining an area that the rumor is a bit harder to mine potentially. And they just started this right before they shut down the mine a couple of years ago. So if they're going to run into trouble, I don't know. And that could actually be a potential upside to the price.
The spot
Who
price.
knows? I mean, look, there's some the valuation here is getting a little stretched. I mean,
Yeah.
so I wouldn't be surprised to find a cap raise here at $33 a share. I think it would be, I don't know what the cap raise was last time. I think they were at 25 and they issued at like 21 or something like that.
Sounds
So there was
about
that
right.
discount there.
I don't remember.
Um,
I've been at the opposite end
yeah.
of company size in this sector, let's say. And then I had the physical, but then
Yeah.
the question is, okay, well, what's the end game for the Sprott Physical Uranium Trust? When I see
Well, I
they're
heard
looking
that they're
to
now actually.
amend it now with
Oh, I know.
conditions that might allow
Somebody
some
is listening.
redemption.
Yeah, somebody's listening to me, apparently. Finally figuring out, oh yeah, what's the price of an asset you can't sell? Zero.
Yeah, it's this question, and I've kind of listened to John Champaglia and whoever else, and they give a good answer, and I still don't know the answer. Interesting. I mean, I get the squeeze dynamics. Sure, you're sequestering these pounds, but then
But
what
then how do you
happens?
get your money back? Like,
Yeah,
okay, yeah, you're sequestering the pounds. Fantastic. This is
yeah,
great. You're now sitting on a pile of glorified uranium dirt that you can't sell under the current,
yeah.
charter, under the current trust agreement. So what's it really valued? It's like you have a kingdom of nothing. Great. I don't know.
So you've got all this money in the bank, but you don't have your access code, so you can't access it.
Yeah.
It's
So,
interesting.
I don't know. What Cameco pays a little baby dividend or something like that. I mean, look, the stock is worth $10.
What about its main rival then, Kazatomprom? Have any
I mean,
thoughts on
Kazatomprom is one. It's so hard to buy Kazatomprom because you got to go. You got to get it in the London Exchange.
Yeah.
So you can do that if you want.
Don't think it's that hard, is it? I used to own it. I don't own it anymore.
I mean, if you got IBKR, it's not that big of a deal, I'm sure. I don't know. I think you're better. You're better. God, you're almost better off with next gen. As much as I hate to say that. I mean, it's just like, the secretaries drive Lamborghinis company, not a lifestyle company at all.
No.
It's the
But I
joke.
guess
But
when
anyway,
you got the best deposits, so and everyone knows it, so they're just hanging out.
I don't know. It all depends. There's this is eerily reminding me of last year where the uranium market kind of got bulled up again, and then it was sort of disappointing. I don't know, folks. I think if you bought lower, do what you want. I mean, people are gonna get upset with me if said, "Oh yeah, he sold way too early." It's like, okay, yeah, I made slightly less than 50%, and it's like, that's pretty good. I bought the bottom, folks. I just didn't expect that the top was going to go up another 30% here.
No one ever does. And then you're playing the liquidity game to try and get out and all that sort of thing.
Yeah.
So Boss, Paladin, they're coming online. Any explorers take your interest, or it's just like, well, hang on a minute.
Oh, I mean, at this valuation, the valuations that you're at now, everything's getting a little expensive again. I think, look, there's still everything out there is such a known quantity. I mean, I don't know. So there's one Explorer, and it's, but it's basically next gen. I mean, that's what it is. I mean, it's but beyond that, it's, obviously Global's had some recovery here, which is good for the Global shareholders because, my God, they've not been in a happy place.
No.
And I think I still think this some people look, there isn't a spot market for uranium. Okay, so everyone needs to realize that yeah, the price is going up. The price is going up based on what UXC is reporting,
and it's the marginal pounds
so
transaction,
you
and then
can't,
they really take that from the term market anyway.
yeah, you cannot go out. There isn't a futures contract right now out there where you can just buy X number of pounds and stand for delivery at 67 or whatever dollars a pound. So it's a lot of noise, basically. That's the problem with investing in uranium, really. It's so freaking opaque.
Yep.
And that makes the thesis, but it also breaks the thesis at the same time. It allows you to have that speculative, if you buy it low enough, that the price can go up and you can ride that wave up, but
that's mainly a liquidity.
You're also, it's like walking out on the Grand Canyon on a glass, at night, on a glass, bridge, and there's no moon to reflect the glass. So you don't know if your next step is going to be the one where you tumble. So it's one of those areas where it's, in my opinion, it's so speculative that you just have to take your profits early and often. Now, there are, there's a lot of ways. I mean, look, I just made a lot of money in this. Don't get me wrong. But, I wasn't going to wait around and say, because, there was a point where it was kind of seeming like it was slowing down. And I was like, okay, well, I'm happy here. Now, everyone has their own metrics as to where they are. I'm going to continue to trade around stuff, but for me, these Explorer Co's, things that I actually even think have some potential, it's a 5 basis points position at most. And it's one at which, once you get to about 50% on in terms of the gains, I'm going to take profits on those. So, and that's what I suggest other people do too. Everyone's free to do what they want. But it's just, don't become the greater fool. That's sort of the thing.
Easy to do in a bull market. Very wise words indeed. All right, so we're coming up an hour and a half. Any final thoughts before we wrap it up? Maybe next time we catch up, we can delve into the offshore services and drills a little more, because that's really to take off. So we'll leave the listeners
offshore
with a teaser.
Well, I was having a conversation with Josh Young, actually. We are actually now talking to each other, because surprise, Josh Young and I can actually get along. Cool. I know. So he's got some plays in the oil services business. So I'm taking a dive into those, and I'll be more than happy to talk about what I find. So
I like it a lot.
But we'll see there. I mean, look, the other portfolio updates, Ecopetrol and Petrobras had 2 very, very important trading days yesterday, because both of them had breakout rallies.
Yes.
In my opinion, anyway. Petrobras has cleared above 15. We have been banging our head against that $15 wall for 2 weeks now, and we broke out above it in a big way. Ecopetrol broke out above 12.50. Both of them had very healthy rallies. So on Wednesday, both of them basically came down, tested near-term support, and the next day shot up. So I was very comfortable holding those. And it was like, yeah, those rallies I saw, I was like, yeah, this is real. Didn't feel that quite that way with Peabody, but I think those are we're reaching a good moment with those. We'll see where they go, but I think if they hold, my $18 price target for Petrobras is by year end is probably going to come true. I think that's what the stock is worth anyway. So, and particularly with oil as expensive as it is, and given the fact that they have raised diesel prices and in the domestic market, so we're going to be looking at probably a fairly healthy dividend for third quarter. Even with the new dividend policy, and it's important to remember that they have not excluded the possibility of year-end bonus dividends.
Yeah.
So that can be decided at the annual meeting. Particularly if they start making money. So everything is really firing on all cylinders for those two plays. I'm very, very happy with their performance. The Colombian peso is strengthening against the dollar. So an 82-cent dividend is now a dollar dividend.
I'm loving it. Yeah.
Huge. 20% increase in just your damn dividend.
FX, yeah.
Didn't have to do anything, just in the FX.
Yep.
It's like, this is fantastic. I love this.
The Medellin hedge, like the Texas hedge, but the
Texas hedge, yeah, that's what it's called. I've heard it called that. It's like, that's cool. I like that. So I mean, look, I think those were two very important days for Petrobras and Ecopetrol. Those are levels that it has bounced against. We have not been able to break through them. We are breaking through them now. If we hold, we are going much higher. Because, of course, you had people that were selling at those levels because we were just hitting our head almost daily on $15 for Petrobras, and finally broke through. And I was like, this is coming. We're going to break through this $15 barrier here. So you had buyers that are coming in. So this is good. We have people, and we didn't immediately sell down. This is saying that, hey, there's people that are willing to long this stock at $15. And if that continues to happen, then we're heading up here, and we're getting all the right signals from management on both companies, really. It's we just keep hearing like good news after good news. It's like we had the wind turbine announcement from Petrobras. It's like, yeah, we're spending $25 million to study it. It's like, oh, okay. Like, yeah, oh God, everyone was saying we were about to go,
we empty the ashtray just to tick the box, and okay,
exactly. Yeah,
let's get back to real business. Yeah,
exactly. So look, Petrobras is going to make a profit. That is its purpose. Lula is incredibly bullish for the company. Why? Because was Bolsonaro pushing Petrobras into the equatorial margin?
No, and we had the whole fuel subsidy thing,
just like constant battle over and over again.
Yeah.
So Bolsonaro was more happy of just like picking fights with management, whereas Lula is actually here basically trying to make sure that Petrobras is going to be Petrobras 10, 15, 20 years from now.
Yeah.
So this is sort of what I said to people, like Lula is actually bullish. Like,
yeah.
And some very important things that came out lately are just final thought is like Brazil is not going to sacrifice their prosperity for what they called correctly neo-colonialism, which is basically, the World Bank and the IMF coming in and trying to tell them how they can develop. And there's like, no, that's not going to happen. We are going to fully, you see this in statements of politicians, Brazil is going to fully enjoy its potential. So that means they're not stopping drilling. And we're seeing the contracts from Rig. They just signed a big contract for the offshore for Aquila of all things. They are not slowing down, and I'm happy to own it. I love it. So
yeah, so do I. All right, ladies and gentlemen, Chapman Scarborough, proven reserves. We're going to wrap it up, and then next time we're going to focus purely on the oil / offshore space. And who knows,
cool.
maybe I can convince my friend Josh to join us. We'll see. It'll take
that would be fun.
Yeah, it would be fun. We'll see. All right, guys, take care. Do your own due diligence and wish you all the very best. Look forward to catching up with you for another recorded conversation soon.